Okay, number 4, net financial assets. So Tim talked about this a bit. The current mainstream view is for monetary policy to manage the economy through the interest rate. We're apparently told that the interest rate, the federal funds rate, basically the short-term interest rate, can control everything and expectations. Fiscal policy gets out of the way, balances its budget, at least over the longer run, balances its budget. Okay, so some of us like to take a bit different perspective on what fiscal policy should be doing. And what we do is we talk about how financial flows in the economy are a closed system. Okay, that one person's deficit is somebody else's surplus necessarily. So if the government's running a deficit, we think of that as bad, but we forget to recognize that somebody else has a surplus. Okay, particularly at a time like this, as Tim said, when you've got a private sector that's attempting to deleverage. Okay, so we have to recognize that the balances of these sectors, because it's a closed system, have to sum to zero. Okay, and if I rearrange that equation a little bit, I have a private sector balance, which is basically the net saving of the entire sector. It's not the same thing as saving. We have to be careful and not try and equate it with saving, or the traditional measure of saving. It's net saving, so it's the spending relative to income for the sector. Okay, so it's largely a measure of financial fragility or stability in the private sector, rather than a measure of saving and capital accumulation, which is what we normally think of with saving. So those are important as well, but we're focusing here on the financial fragility issue. Okay, so we could take the government deficit minus the capital account there. Okay, and so if we wanted to graph what's going on here, this is the one that if you've followed our work at all, you've seen this one millions of times. But the change in buffer of net financial assets, again, is basically the federal government's deficit, because the federal government, when it runs a deficit, somebody else ends up holding the treasury, and that's an asset. And it's a net financial asset because there's no liability anywhere in the private sector. There's only an asset as a result of the government deficit. Okay, the government ends up being the one with the liability. So the significance here is this quantity is changing. Okay, you can see it changing from year to year. And it moves very closely with the private sector balance there. Okay, that's the main thing it's moving with. Mirror image, of course. So the private sector wants to net save more. The government runs a bigger deficit. As it turns out, those spikes where this widens tend to be recessions, right? That is the recession. The private sector decides to save more of its income instead of spend it. That is the recession. Okay, and then the government sector, frequently automatic stabilizers, right? Tax revenues fall and so forth, runs a bigger deficit. It could be a more activist approach with government stimulus. So either one of those would show up here. So one of the significant things is you can look at there and you can see that the private sector, on average, likes to run virtually permanent private sector surpluses. Okay, the two times that it didn't were the stock market bubble in the late 90s and the housing bubble in the 2000s. Okay, and then people like Dean recognized those problems going on. From this analysis, we saw this coming on as well. That something was very wrong there. Oops, something was very wrong there if the private sector all of a sudden was happy net dissaving. Okay, because that's completely at odds with their historical behavior, and so that led us to believe there was some financial fragility increasing in the private sector. Okay, so let's look a little bit at what fiscal policy does and look at how this understanding of net financial assets helps us understand fiscal policy and monetary policy. So fiscal policy, when we run a government deficit, basically what we end up with is the household sector ends up with a net asset. Well, in this case, I'm thinking of government spending, but you could do it with tax cuts and so forth. But let's assume it's government spending, sending a check to the household sector. So the household sector would get net deposits there. And that is an increase in net financial assets because they have a deposit, but it raised their capital, it raised their equity. Okay, there's nobody there holding the liability. If we require the Treasury to issue securities in exchange, then it looks like this, but this is not a change in net financial assets. This is an asset swap, where the dealers, which is represented by those guys up there in the top right, buy the Treasury security. So each one of those has something coming to it and going away from it. So there's no net increase in the position for anybody in that sector. So when we, oh, I guess I was supposed to do this. I'm going to skip that one. So when we have a Treasury sale, there's no change in financial assets. And from 2, there's no change in the ability to create credit and deposits because reserves are a buffer. Okay, so we like to think, we're told to think that when the Treasury issues securities, instead of, quote, printing money, it will be less stimulative to the economy. But when they issue a Treasury, actually, and they drain, when they issue a Treasury, the banks still have as much ability to create loans as they did before, even if you're draining the reserves. And from buffer stock 3, the Treasury collateral actually ends up financing more credit in the financial system. It doesn't slow anything down. There has never been anybody who is unable to spend because they're holding a Treasury. Okay. In fact, we have 20 plus dealers out there that are willing to buy that Treasury from you at any moment. Okay, so the point I was going to make here between these two was that there's not much difference if we give the Treasury an overdraft and pay interest on reserves, or the Treasury sells a security when it runs a deficit. The most important thing here is that it's increasing the net financial position of the private sector, as I've got there. Okay. When we look at fiscal policy, there's a couple of things. First off, we affect the price of credit, which ends up, if we do it right, we end up with more credit creation to try and stimulate the economy. Okay, and as Dean pointed out, that can create, that can be very useful in the sense if you have refinancings and so forth. But what you're attempting to do, and we don't often think about this, is something very different from fiscal policy with monetary policy. With fiscal policy, you are attempting to get the private sector to spend more out of an increase in income. With monetary policy, you are attempting to get the private sector to spend more out of existing income. Okay? And we don't talk about that because, in fact, we confuse the terms money and income. And so when the Fed creates money by doing what I have there on the bottom, which is buying a Treasury or mortgage-backed security and raising reserve balances and deposits, then we think that that has added jet fuel to the economy the same way if it was income. But it's an asset swap, right? And the dealer had every ability to expand its own balance sheet before it got the deposits. Okay. Okay, so fiscal policy creates, and this is the distinction I would make between fiscal and monetary policy. It creates and destroys net financial assets through its deficits and surpluses. If you're trying to stimulate the economy with fiscal policy, you're trying to create more spending out of more income. Monetary policy does not change net financial assets. What it attempts to do is create more spending out of existing income, either by reducing interest rates or pushing everybody into lower yielding deposits from their treasuries or from their mortgage-backed securities. Okay? Or by doing QE to try and reduce interest rates, which is doing both of them. Okay? So we like to talk about something, and you have to be careful with this because this is not intended to be an actual equation, but for those of you that took Economics 101 and you learned MV equals PY, where it's the money supply times the velocity or the turnover of money equals nominal GDP, quantity theory of money, we like to talk about the quantity theory of net financial assets, which is basically, as Warren Moser likes to say, the monetarists are right, they just have the wrong money. So the money we like to talk about is the net financial assets that are accruing to the private sector, and again, in a buffer stock manner because the private sector wants more or less of them based on the state of the economy. But they tend to want a positive amount of them, increasing amount of them each year. And then the velocity would be some function of desired private spending out of private sector income. And so when we think of monetary policy, it's attempting to increase V, and fiscal policy is attempting to increase M. Okay. And that's, for us, a useful way to distinguish between what fiscal and monetary policies are doing. Okay, so what are some implications here? Okay, so what does excess money mean? Excess money here would mean, and we're talking about excess money from the traditional monetarist perspective, where you have too much money chasing too few goods and you get inflation. It would mean a buffer of net financial assets that's too large given desired private spending relative to income. Okay, so the government's deficit then would be too large relative to what the private sector wants to do. Okay. But what we noted before was that the quantity of net financial assets, or the growth in net financial assets, tends to be positive, that there's a desire to have about 2% government deficit on average, 2 or 3% government deficit on average, all the time, although it's a fluctuating amount. And this is different from the way that we think of fiscal policy in our traditional new consensus model, which is, again, fiscal policy, get out of the way. But what if, in fact, we need net financial assets as a buffer stock for sustainable private sector spending relative to income over the longer term? So it implies net financial assets as a buffer, and that should become part of the monetary policy reaction function, which is, again, different from the received view, which is that fiscal policy get out of the way and let monetary policy be independent. Okay. Given net financial assets buffer in the reaction function, debt service as a policy variable must also be in the reaction function. Okay, what am I talking about there? Well, if the government's going to run permanent deficits, and a fluctuating amount, but generally permanent deficits, to enable the private sector to net save, then you're going to have the issue of government debt service. Okay, and that's going to be affected. That turned out rather sloppy, but that's going to be affected by, the debt service is going to be affected by the interest rate that the central bank is setting in its monetary policy reaction function. And so you have some potentially perverse effects. If you look down low there, if you have a government with a high debt to GDP ratio and you start to increase interest rates to slow the economy down, you're going to get more government spending on debt service. Okay? And so you could speed up the economy when you wanted to slow it down. And so this has some significant implications. And we're running into that now, and Japan is running into that, which is the deficits that have been run to provide that, to offset the private sector's desire to save the last 4 or 5 years and the last 20 years in Japan have led to large increases in national debts. And so at some point, raising interest rates, the central bank raising interest rates, is going to come up against the fact that this could, in fact, create an increase in government spending that might offset the slowing down effect that you would expect from raising interest rates in the private sector. Okay, so it's going to require a coordination of some sort between fiscal and monetary policy that recognizes this permanent need for a buffer stock of net financial assets.